Today on InvestTalk, we talked about how to reallocate your money from money market funds. We answered questions on UEC, Berkshire Hathaway, and FSS, then ended the day talking about a new innovation from Apple through their AirPods.
This is InvestTalk. Independent thinking, shared success.
My main focus point today considers a topic that will probably hit home for a lot of people, as there's been, I'd say, a lot of fear over the past year in the market for good reason. And because of that, a lot of people have parked their cash in money market funds. But experts advise maybe you should start moving that cash, as money market accounts are still surging. And that's because the $6.3 trillion that are currently in money market accounts are going to have an awakening over the next 6 months or so as the Fed cuts rates and the free ride above 5% is soon coming to an end. And so, as I mentioned, while stocks and bonds have been on a roller coaster ride over the past few years, one area has been blissfully steady, and it's those money market funds. Because for over a year now, you've been able to get those high returns that I was talking about, over 5% with pretty minimal risk. But the shelter that money market funds provide may not last forever. In fact, they're going to start to see those rates fall pretty quickly and pretty soon. So what should investors be considering now is really the question. What are the options in front of you? Well, there's a lot of options. It depends, I think, primarily, I would say, what that money is for. If you were parking cash in money market funds for short term, well, you could certainly still continue to keep it there. If you had money in there that you didn't really mean to invest in long term, not that fear money, but that I need this quickly money and I just want to earn a little bit of yield, well, keeping it in money market funds or other short-term corporate bond funds is certainly fine. And if you wanted to continue to have lower risking assets over the long term and we're focusing on income, well, maybe you want to actually extend the duration of the fixed income investments you're investing in. You'd want to go longer in terms of duration of bonds, longer maturity in bonds. Why? Well, when interest rates fall, higher duration assets tend to have a higher rate of positive performance. Why is that? That's because they're more interest rate sensitive, because the bonds that are issued today on higher interest rates are going to be worth more if interest rates writ large fall and new issued debt is on lower interest rates. And so it's important, again, that to understand that you're still going to earn positive real returns with money market funds. That's certainly going to be a thing. But it's just going to be less, and it's going to be a worse trade-off between, okay, I want the safety of 5%, and people who have been in money market funds over the past year have certainly missed out on equity returns, right? Over the long term, we know that equities tend to outperform bonds, they outperform cash and cash-like instruments, but it's only for those that are willing to stomach the risk. So then I would say, again, even though the market is at an all-time high, it could also be a good time, if you're invested for the long term, to reorient your portfolio towards equities. I saw research months ago that I have mentioned several times, and that is you have a higher expected return from investing in the stock market on all-time highs than you do all the other days combined. Now, that doesn't mean that there are any other days that are going to not be better, or that some days aren't going to be better than all-time highs, but generally, over the long term, the market appreciates in price. In 2022, as we all know, soaring inflation led to rate hikes that eventually boosted the performance of these funds, and today we're enjoying from the benefit of that. But let's look at it from the long term. While money market funds have had their moment, they're not typically a good long-term investment. Over the past century, money market-like returns have averaged 3.3% annually. Compare that to 10.3% for stocks, 5.1% for government bonds. Factoring in inflation and taxes, money market funds and treasury bills often yield negative real returns over time, while stocks have consistently over longer time horizons, not year after year, but consistently over longer time horizons, provided positive real returns, inflation-adjusted returns. And so if you think you've been benefiting from the high rates of the past year, congratulations. But it's time to think long term. Money market funds are still great for cash you need in the next year or two, or the next month or two. But for anything beyond that, a mix of stocks, bonds, low-cost index funds, certificates of deposit. Maybe you want to go to your bank and lock in an interest rate of money you know you won't need, that you don't want to put in the market. There are so many other options that you should be considering now as rates are starting to fall. Money market funds have certainly been a safe haven during a period of very high inflation. But with rates coming down, now is the time you need to reassess your strategy and plan for the long term. Let's dive into the market today. And really this week, U.S. equities closed the week and capped off a fifth straight day of gains after a notable slide from last week. The Dow up 72 basis points on the day, the S&P 500 up 54 basis points, the NASDAQ up 65, and Russell 2000s leading the pack up 2.49%. Now, the NASDAQ posted its best week since November of 2023, while the S&P is now within 1% of its July record close. It's tough to pick out my favorite sectors of the day because all sectors were higher, but semis, home builders, retail, energy were among the standouts. Mag 7 names were mixed to cap off a pretty big week across the board. Relative underperformers, looks like medtech and pharma didn't do particularly well today, but still positive. Dollar index was down 30 basis points. Gold finished up 1.2%, pushing further into record territory. Crude oil settled down 50 basis points, but still locked in a weekly gain after 4 consecutive weeks of drops. Latest leg up driven by really a ramp up in the 50 basis point rate cut expectations overnight after some recent financial press pieces suggested the Fed hasn't really closed the door yet on an outsized cut for Wednesday, September 18th meeting. That would be next Wednesday. Today also saw a boost in the soft landing optimism after the Michigan inflation expectations are back to the pre-inflation surge levels. Consumer sentiment came in higher than expectations, helped by improvement in both current conditions. Release noted consumers still remaining guarded, but buying conditions for durables improved amid better perceptions about prices. Now, to sum up the week on the bullish side, one good thing was with respect to AI. There was a renewed AI secular growth theme. The momentum from that really drove a meaningful tech rally. Oracle's results also played into that positive AI sentiment. Goldman Sachs said valuation of AI basket has normalized. And as I mentioned, the door is still kind of open for a 50 basis point rate cut next week. In fact, Fed's BAR confirmed favorable capital changes for banks as well. The planned increase now is supposed to be 9%, where it was expected to originally be 19%. And there were some signs of less stretched sentiment across the board and positioning as well. On the bearish side of things, election uncertainty ramped up following the debate. That's really going to be an overhang for the next 50 some odd days, and likely going to be a source of continued volatility. Desks also continue to highlight negative seasonality and the fading buyback bid as we move into the blackout period. Both core CPI and PPI came in a bit hotter in August, with shelter inflation again an area of scrutiny. That's not a word. Scrutiny is a word. Goldman Sachs noted trading business trending down close to 10% in the current quarter, which is worse than what people expected, and the second straight week of outflows from U.S. equities after 10 straight weeks of inflows, and the biggest weekly outflow since April. Looking ahead, next week brings retail sales, housing data, and the first regional manufacturing prints for the month of September. But most importantly, Wednesday is going to be the FOMC decision, as well as the updated dot plot. And so that's going to be the biggest macro market moving, we like alliteration here, event of the week.
Hi, Duncan from New York. Thank you for all that you do. I got a quick question about an ETF. It is a Vanguard VOO. I think it mimics the S&P 500. What I'm basically looking for is not to actually get the S&P 500, but something similar to that too. Reason why I'm looking into this is the expense ratio is about 0.03%. I think one of the lowest, and it's the Vanguard 2. I just wanted to know your thoughts, or if you think something else is better with this. It's more of like a really long-term set it and forget it. And I have 2 portfolios, one growth and one I would say value. Do you think I should put this in the growth or the value? Just want to be organized. Thank you very much, and have a great day. Bye.
Well, first off, I love your organization. So let's dig into this. VOO, the Vanguard S&P 500 ETF, is a Vanguard ETF that tracks, you guessed it, the S&P 500. And it's actually, I think, probably the most popular fund that tracks the S&P 500. They have a $505 billion under management in this fund. And because it's just a passive index tracker, it has a very low expense ratio, 3 basis points. If you're ever looking at an ETF and it has a high expense ratio and it is a passive fund, run and hide. That is not the case here. Now, certainly if your goal is to get S&P exposure, this is an excellent way to do it. This is generally going to get you the S&P return. Now, there might be a little tracking error issues around trading, but generally speaking, gross of fees, it's going to get you the S&P 500 return. It's going to be low turnover. It's only going to rebalance when the S&P rebalances. So exactly what you'd expect if that is your goal. Certainly, you're going to want to keep in mind you're going to have a lot of exposure to tech, a lot of exposure to financials, but you already know that if this is what you are seeking. Now, given that it has 40% exposure to tech, given that it mimics the S&P, its largest holdings are Apple, Microsoft, Nvidia, Alphabet, Amazon. This is a more growth-oriented fund. So, it's not like a Russell 3000 that is going to be the entirety of the US market. This is just a large cap fund, and it is heavily exposed to those tech names. So it certainly is on the growthier side of the market. Price to book is about 5. Weighted average price to book is 4.9 right now. So yes, certainly on the growthier side of the market. So I would put that in that portfolio. But, if they're both brokerage accounts, it doesn't really matter. If they both have the same tax treatment, it doesn't really matter. And I'm glad that you're organizing. But remember, you need to manage your portfolio holistically. Keep in mind everything you're holding, diversify across everything together, not separate. But if you're trying to organize, growth it is. Thanks for the call. Now, shifting gears, let's head over to our InvestTalk YouTube channel question bank. I want to remind you that, when you leave a question in the comment section of our InvestTalk YouTube channel, we like to get to those as soon as we can. So let's tackle one from Jimmy Gustafson right now. And his question was about FSS. And the question is, what are your thoughts on Federal Signal, the numbers and balance sheet and so on? Looks fine, I think. Maybe a little expensive for the moment, though. So FSS is a government contractor that has 2 groups, their Environmental Solutions Group and their Safety and Security Group. They primarily work with municipal governments, some industrial businesses. And looks like in the first quarter, growth looked pretty strong and margins were being pushed up as well. Cash flow has been improving after flatlining from 2022 to 2023, improving pretty significantly, and margins have been expanding as well. It's a $5.2 billion market cap company. It's got $321 million worth of debt as of the end of last year. That's been pared back to $284 million, but its interest coverage ratio is 19 times. So it's got plenty of wiggle room ahead. Now, they've issued a little bit of shares in the past couple of years, but only about 1 million, and they had 60 million shares outstanding since 2020. So nothing crazy there. The earnings per share has been consistently upgraded since February, which is something that we certainly like to see. And overall, they've had a pretty positive outlook from their forward-looking guidance, along with some macro tailwinds given the business that they're in. The revenue growth over the past 5 years, almost 10% on an annualized basis. That's pretty significant. And if you look here, for those of you who are viewing this show, you'll see from 2020 to 2023, it's pretty consistent growth. It's not like a lot of the growth happened in 1 year and then tapered off. It's pretty consistent growth over the past 4 years. As I mentioned, those margins expanded on the bottom line from about 8% pre-pandemic to 9% last year, projected to be 11.5% this year. The return on assets, return on equity is improving. All these things look pretty good to me. So the question becomes, was it expensive? And the forward-looking price to earnings is 24 times, which is a little high given the business in which they operate in. It's up 53% on the 52-week, up 13% year-to-date. So still a pretty significant price appreciation over the past year. And that's pushed its price to earnings about 25% above where its 5-year average is. Its price to book is 4.8, also high above its 5-year average. Its price to sales is only 2.9 times, though. Price to cash flow 23 times. I would say given the recent run up in the past year, it does look a little bit expensive to me. And so you can see in their chart that it had a little bit of a drop off in mid-September, and it's since recovered. There's some pretty strong support at like the 83 level, it looks like 84 level. And so it might range here for a little bit, but I would wait for it to pare back a little bit, especially the run up from 60 all the way to peaking out at about 100 in the middle of the summer. So I think you got room to wait on this guy. Looks like a well-run business. I agree with you. The balance sheet looks pretty stellar, and looks like they're making some solid improvements.
I was calling regarding Berkshire Hathaway. I was wondering, due to Berkshire owning both Occidental Petroleum and Chevron, I hold a sizable, it's my largest holding. I was wondering if that's a safe and reasonable move on my part, or if I should start investing in more individual energy companies. Thank you.
That's an interesting question. They do derive Berkshire a lot of their revenue from energy, right? Berkshire Energy makes up a pretty significant portion of the company. Now, Berkshire Hathaway, I don't think I have to tell anybody what Berkshire Hathaway is, but it's Warren Buffett's company. It was actually the first company for a bit to reach $1 trillion, first non-tech company to reach $1 trillion. And so, taking a look at their business segments, you can actually see Berkshire Hathaway Energy makes up 11% of their total operating income. That's a pretty significant percentage. And so, yes, the revenues of the company are going to be tied somewhat to the prevailing conditions of the energy sector. And so that is certainly a consideration to have when you're looking at allocating to it within your portfolio, especially if your largest holdings already are energy names. Now, focusing too much on this, however, because it is a diversified business, we've talked about them several times, most recently, about how they have their hands in pretty much every aspect of the U.S. economy. But taking that a step further, then, when you invest in BlackRock, when you invest in any asset manager whose sole business is predicated upon fees charged on the assets they have under management, assets are growing based on how the funds are doing. The funds are performing based on how individual companies are doing, how sectors are doing. And all the financial companies that are asset managers are also exposed to those. So, I think it's something to consider, but you have to understand that it is a very diversified business. They have manufacturing, they have services and retailing, they have insurance, they have all sorts of things that have helped them be organized in such a way that they aren't too heavily reliant on any individual thing. So if you want to allocate to Berkshire Hathaway in your portfolio, I think that's fantastic. Maybe at the same time, you might want to consider trimming energy a little bit. But either way, yes, consider it. But I wouldn't not invest in Berkshire just because you got a lot of energy names. Thanks for the call. Now, today is Friday, which means we like to fit in a quick rundown of key benchmark numbers. So let me hit you with those right now. The 2-year Treasury yield was at 3.576% today. Last week, that was 3.677. 6 weeks back, it was 3.882. 44 weeks ago, it was 5.05. And 142 weeks ago, I still can't believe it when I read it, 64 basis points. The 10-year Treasury yield was at 3.646%. Last week, it was at 3.723%. 2 weeks ago, it was at 3.921%. 44 weeks back, it was at 4.63%. And 138 weeks ago, it was at 1.762%. Gold was priced at $2,583 per ounce. Last week, it was at $2,495. 44 weeks back, it was $1,935. And 132 weeks ago, $1,806. Silver today was at $30.65 per ounce. Last week, that was $27.92. 30 weeks ago, it was at $22.80. And 125 weeks ago, $23.94. Oil was selling for $68.65 per barrel today. Last week, that number was $67.82. 40 weeks ago, it was at $74.30. And 140 weeks ago, it was at $66.62. The national average for a gallon of regular gasoline is $3.23 per gallon, a 6-cent decrease over the last week. 67 weeks ago, it was at $3.56, and 115 weeks ago, it was at $4.25. In California, it was averaging $4.76 per gallon, a 10-cent increase from last week, moving the wrong direction. 46 weeks ago, it was at $5.32. 122 weeks back, it was at $5.87. For comparison, in the state of Kansas today, gas was averaging $2.95 per gallon. That is $1.81 less per gallon than gas in California. Now, we've already answered a question today on ETFs, specifically the S&P 500 ETF from Vanguard. But I want to talk about different thematic ETFs. And that's because investors are flocking to ETFs, exchange-traded funds, that focus on reshoring or bringing production back to the United States. After years of supply chain disruptions and increasing tensions between Washington and Beijing, companies are understandably expanding or even relocating their manufacturing operations back to the United States, and investors are trying to capitalize on that trend. So far this year, about $2.25 billion has flowed into reshoring-themed ETFs, bringing their total assets to a record $9.6 billion by the end of August. Now, along with these flows, manufacturing activity has certainly been picking up, driven by corporate moves, but also government funding. Taiwan Semiconductor Manufacturing Company is boosting its investment in Arizona plants to $65 billion. Century Aluminum received a federal award of $500 million to build the first U.S. aluminum smelter in 45 years. And so this move, along with Congress's approval of over $1 trillion in infrastructure funding and $200 billion for chip manufacturing, are certainly helping to fuel this reshoring trend. And because of this, ETFs that are tied to this theme stand to benefit. And that's really no matter which political party wins the upcoming election. BlackRock noted correctly that this is kind of an area of rare bipartisan consensus these days, with U.S. job creation and specifically U.S. manufacturing being very central to both parties' agendas. Now, BlackRock may be a little biased. They recently launched their own reshoring ETF through their iShares, the iShares U.S. Manufacturing ETF, which has, in fact, actually attracted $6 million in assets since July. Now, the U.S. manufacturing sector has been a strong performer this year. Caterpillar, Eaton Corp posting year-to-date gains of 16.4% and 27.6% respectively. And so while concerns remain about many things, potential slowdown in U.S. growth, potential global slowdown, Chinese demand, highlighted dip in U.S. manufacturing construction spending, in spite of all of this, investors, and myself included, are optimistic that reshoring will remain probably a pretty powerful trend over the next couple of years. Now, it's important to note, as with anything, this boom doesn't come without its challenges. Companies are expanding their U.S. production, and because of that, they're going to face higher labor costs, higher raw material costs, and so that could affect their profitability and certainly may also affect consumer prices. Reshoring is not some perfect and guaranteed ticket to higher returns. These companies that are manufacturing things may end up having to pay more to manufacture them. Margins may slip. But in times of supply chain disruption, they certainly will be less affected. It won't have as much of an inflationary pressure as it did over the past year. All in all, I think if you have been listening to this program, Justin and I have been talking about reshoring, friendshoring, onshoring for quite some time. And so it certainly appears as though the market is starting to take notice. And anytime the market starts to take notice and investors start allocating capital to certain themes, it's important for us to pay attention as well. So this has been a theme, as I mentioned, that has been going on for quite some time. Looks like everybody is starting to run to it, and it's likely to continue into the future.
Hi, this is Ben from Virginia. Just had a quick question. I was curious what your thoughts are on UEC as a play being long on nuclear energy, nuclear power, as opposed to something more like an ETF or something like that. I'm looking at URA as an alternative. Both of these are a little over 4.5% of my portfolio each at the moment. So I've got about almost 9% or so in this sort of nuclear play. But UEC has taken a beating recently, but it seems to be into some relatively recent support at this moment. I picked up a little more the other day on its way down, and it dropped a little more. I was just curious what you thought about UEC overall, and then whether or not maybe would be preferable over something more broad like URA or some other alternative, or looking further into the space. Thanks so much. Appreciate it.
Yeah, so for those of you who do not know, UEC is the Uranium Energy Corp. How do I describe this? Well, so it's a company that aims to engage in uranium mining. And why I say aims is because, yes, they do own some mines. But if you look at where their revenue comes from, they have two different business segments. One is the toll processing services segment, which is about 30 basis points of its revenue. But actually 99.7% of its revenue comes from the purchased uranium segment. And so that's because the company doesn't really have operating mines. I think their Wyoming mine might have come online last month. But what they did do is over the past couple years, particularly after the Fukushima power plant disaster in Japan, they started buying uranium when it was incredibly cheap. And so they had this big stockpile of uranium that they ended up selling for some pretty good profit as uranium has become back on the forefront of being maybe baseload necessary for a green future. Now, this company has a market cap of $2.146 billion. It's got no debt at all whatsoever, but it kind of struggled to make a profit. Its cash flow has been improving until this year. It kind of dropped off a cliff a little bit. And they've been doing some acquisitions as well, purchasing some of these mines, that Wyoming project. I think a couple of their mines that were closed that they're trying to bring back online for operations as well. And so it's important to note that they have been issuing a lot of shares over the past 5 years. From looks like 200 million shares outstanding to 400 million, doubled their shares outstanding in the past 5 years. And so you ask yourself, how can you purchase things and how can you acquire mines and such without having any debt? Well, that's how. And so that's certainly something that should be concerning to any investor, the threat of having your position diluted. And so with all of this in mind, it's currently trading at a forward-looking PD of 48 times. Its price to sales ratio is 54 times. Its short interest is about 13% right now. And so I think the market is probably going to agree with me when I say that this company is overpriced. Why? Or it's overvalued, rather. Why? Because those two things mean the same thing. Because it made a great trade. They made a fantastic trade. They did the textbook buy low and sell high. It's what we all hope to do. But they kind of burned through that stockpile. And so with that being said, well, now they're going to have to start focusing on reopening recently closed mines. They're going to have to focus on their Wyoming project, which they recently acquired, and I think, again, might have gone online in August. I can't recall off the top of my head if that's the case. And so I would stay away from this name right now. It's down 20% year to date. It's only down 2% on the 52-week. I think it has a lot of potential, but I think there's a lot of uncertainty as the business itself is predicated upon kind of being able to operationally manage some of these mines that they really haven't been doing. Again, I say it one more time, just redundancy for the sake of clarity. Their primary source of revenue has been their excellent trade. That's kind of dried up now. So if you want to get into uranium, I'd probably suggest doing it in a more broadly diversified way. Thanks for the call. Let's dip back into our InvestTalk YouTube channel question bank. This question about ticker MEDP. The question is, excuse me, do you like MEDP stock? And what would be a good entry point? Well, MEDP is Medpace Holdings. And Medpace Holdings is a company that outsources clinical development services to biotech and biopharma companies. So they handle clinical trials is what they do. And so generally speaking, when debt is pretty cheap and financing is pretty cheap, a company such as this is able to sell its commercial services to companies that need their research done. And so it's split into three main segments and then kind of a catch-all segment as well. Oncology, metabolic, cardiology. It's certainly three aspects that are getting a lot of focus recently, right? With the trend in GLP-1s for metabolic issues. Obviously, cancer is always a heart button issue because it's a terrible disease that we all want to defeat. And certainly as time has gone on, I believe still the number one killer in the US of adults may be heart disease. But regardless, I think the important thing to note here is that growth has been pretty stellar over the past 5 years. It's up 21.8% on an annualized basis over the past 5 years. And it also has been expanding its margins as well, from 25% gross margin to 26%. Its net margins have improved from 10% to 15% in the past 5 years. They bought back shares. Very little debt on a $10 billion company, $164 million in debt on that $10 billion company. And their earnings have been upgraded as well. Their cash flow is improving. Their profitability is improving. It's up 14% this year, up 24% on the 1 year time frame. From a relative valuation basis, it's actually priced below where it has been over the past 5 years. So I think overall what you see here is a business that is run pretty well. It's run on low debt. It doesn't issue equity to deal with the fact that it's run on low debt, which is something that we like as well. Now it's had a run up, but even with that, I think it's still at a pretty fair valuation. So MEDP, I like it. I kind of like where it is now. Thanks for the call or the comment. Now, I know that usually the stories that we bring you are about market trends or investment tips, but sometimes you just got to take a victory lap on some fun ones. And so Apple just made a big announcement for a 2-year-old product that could change how people with hearing loss get the help they need. Amid the flash of new iPhones and Apple Watches, Apple revealed that the AirPods Pro 2 will soon have a new feature, a hearing aid function, accessible to anyone. This move provides a more affordable alternative to traditional hearing aids, offering a sleek all-in-one solution that could revolutionize hearing healthcare. You know, a hearing aid, I think, can cost between $1,000 and $3,000 per aid, which can be pretty costly over time. Now, this is all possible because the FDA made a decision in 2022 which approved over-the-counter hearing aids. And now with the FDA approval expected this fall, Apple's clinical-grade hearing aid capability will roll out as a free software update, allowing people to use AirPod Pro 2 as an FDA-approved hearing aid. Users will be able to take a 5-minute hearing test right from home, creating a personalized profile that boosts specific sounds like speech or enhances noises in their surroundings. This function is designed for people with mild to moderate hearing loss, and the results of Apple's hearing tests will be stored in the Health app, where users can monitor their hearing over time. This makes AirPod Pros 2 not just another set of earbuds, but a powerful tool for hearing healthcare. Now, what's more, millions of people already own these second-generation AirPods. I own them myself. Now, I don't have hearing issues, but just to say that there are a lot of consumers that have these in their homes already. So what you will have if you already own them is instant access to a new feature without needing to purchase a traditional hearing aid. Frankly, I think it's a game changer for those who suspect that they have hearing loss, but don't really want the stigma or cost associated with hearing aids. Some people are embarrassed. They shouldn't be, but some people are. With AirPod Pros 2, it's simple. Just popping the earbud in. The same ones you use every day. Other brands are trying to hop on as well. Sony and Jabra, not sure how you pronounce it, have launched their own over-the-counter hearing aids as well, but none really have the ubiquity and seamless integration of Apple's ecosystem. And at $249, the AirPod Pro 2s are significantly cheaper than Sony's $1,000 hearing aids or Jabra's $995 model, just slightly cheaper than Sony's, or the hearing aids themselves, which can range to $1,000 to $3,000. Now, that said, it's also important to note that users will need an iPhone with iOS 18 or newer for the feature to work, and that could raise the overall cost for some buyers. You know, it's like I said, generally we bring stories to the table that will give you market trends or talk about what's happening within the industry, or overall just try and give you a better idea of how you should invest to achieve your financial goals. But I don't know, this to me is kind of like a victory lap, right? It shows what innovation can be done when we break down some of those barriers. I've said it a couple times, traditional hearing aids are incredibly expensive, and some people are, though they shouldn't be embarrassed to have them. And so what this does is it creates a new market, right? It creates a new market for alternative products. It gives consumers more options, right? It's the definition of capitalism here. It drives prices down through competition. Now, because of this, Apple's AirPod Pro 2 are set to become the most visible, but also the most invisible hearing aids ever. And hopefully this opens up hearing assistance to millions of people who might never have considered it before. And so certainly if you have a loved one in your life, that maybe encourage them, or not encourage them. I'm not selling a product here, but certainly this should start a new trend of us looking at ways that we can break down some of those barriers to have products that actually improve our lives. Before we head off for the weekend, and I hope you all have a restful and relaxing weekend, I just want to remind you once again that the KPP Financial InvestTalk Wealth webinar, hosted by myself and Justin, will be happening on October 8th. It's new, it's free, and it'll focus on the effective strategies for managing your 401k and enhancing your retirement savings. It all happens online from the comfort of your homes, your offices. Maybe you want to pull over to the side of the road because you're driving home and it's already started. But either way, if you're interested, head over to investtalk.com and sign up for our wealth webinar. A reminder, that's October 8th, and it's free, but you do have to register. Now, I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. You and they can get those at iTunes, Google Play, and Spotify. Just please be sure to leave us a rate or review on iTunes. That really helps us out. And I hope that by now we've been telling you and you've remembered that we are also available in video form over on our InvestTalk YouTube channel. That's InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.